Hi, everyone. I'm Doug Alsdorf, the author of Financing Your Future. This is chapter 7. We're going to start over the next many chapters, 9 chapters, that we're going to focus on investing. So, here we're going to talk about what are my investing recommendations. And this is the introduction to those chapters about investing. So, a reminder, this is really an important thing for me to continue to remind you about, which is to read quality books. Here are my 4 favorite books. A lot of what I'm going to talk about is related to the content in Burton Malkiel's book, A Random Walk Down Wall Street. This is such a critical book. If you read one book, I hope you read more, but if you read one, definitely please read this book. That'll really help you understand investing. And we're going to go over a lot of these details. So here are those 9 chapters talking about investing. And now the next 9 videos are going to start with this slide telling us where we're at in this content of looking at investing. We're going to end up talking about stocks and then active and passively managed funds. How long do you have to invest? IRAs and 401ks. We've already mentioned those in chapter 4 on taxes. And then finally, I want to encourage you to do this for yourself. So let's kind of get started into this. And when we get started investing, one of the things we do is we hear stories, and stories are absolutely wonderful to encourage us. So we'll hear stories about somebody who got rich. And this is one of many, many stories you can find. It's a recent story, only a couple years old. I invite you to go ahead and have a look at that story, read it, and see if you come to the same conclusions that I do, which is this story a general pathway for making money? No, it's not. So, what parts of the story are helpful for us, the everyday investor? Well, it's a true story. The person did make $170 million over 4 decades. They had an ordinary income in the 1980s. They were making about 55,000 and about 110,000 in the 2010s. It's an inspiring story. An ordinary person was able to accomplish massive wealth without really, the help of any financial professionals. They did rely on friendships to talk about their investing, so it's always good to have friends. They had a simple life. They lived small, didn't have kids, married later in life, no debt, and kept their expenses low. That's very helpful. They bought and hold. They did compounding, and that's really awesome. And they were altruistic. This person was truly altruistic. More money magnified his generosity, and that's just fantastic. So those are really good things in the story. But there's parts of this story that are not helpful and actually dangerous to the everyday investor. You'll read these stories on the internet and pay real close attention to them. You'll find them yourself. Often they lack specificity. So it says the person who got rich, his name was Avedisian. He read the Wall Street Journal and Investors Business Daily and business prospectuses. Okay, great. The only detail in the actual write-up in that link, the only detail mentioned was he avoided companies where shareholders are selling. Okay, when the owners are selling the company, that's not something you want to buy, right? That just kind of makes sense. Quote, rather than simply taking market averages via index funds, which is something that Malkiel and the rest of us are going to recommend you actually do, Evidesian tried to identify a few great businesses that he could buy and hold for decades. So buying and holding is great, particularly with index funds, but buying and holding just a few stocks, that's really risky. And we're going to talk about that risk. When he gained conviction on a business, he concentrated his bets, all his money, at one time. He said he usually owned less than a dozen companies. And we're going to learn that it's actually kind of hard to pick less than a dozen companies and make money. But here's the problem. What's the specific criteria for selecting those companies? It's easy to say buy winners. That's effectively what this is saying. Buy winners. So how do you select them? What's a winner? That's incredibly difficult to do. And we're going to see that in the upcoming chapters, how hard it is to do that. The stories are often purposely vague, such as this one. Evidesian is reluctant to give details on specific holdings. That's not advice at all. It's the opposite advice. It's a secret, saying only they were major companies, household names you'd recognize. That's not investing. Buying on margin. He bought on margin. What does that mean? He borrowed money and invested the borrowed money. We've already learned how expensive loans are. Now imagine borrowing money to invest. This is speculation. When you hear the words margin and leverage, those are signals for borrowing money. And he opened 13 brokerage accounts. I think two is plenty. 13 is really dangerous. Bought options. And again, these are too risky for the ordinary investor. These two things right here, anytime you hear these words, buying on margin and buying options, that's speculating. That is gambling. I really hope you don't want to gamble with your financial future. So, how do you feel right now? Maybe you're thinking, hey, I could have done that. Yeah. Or maybe you're thinking, hey, I wish that was me. Or maybe you're grumpy and you just say, well, it's all lies on the internet, anyways. The problem I have is stories like this mislead the ordinary investor. They make it seem like anyone can accomplish this massive wealth if they just try, but they lack the necessary specifics that you can use and follow in order to make money. The stories hide the fact that people are actually gambling. When you read these stories about getting rich, a lot of people are just gambling. They're guessing and got lucky. Do you want to gamble with your financial future? Boy, I sure hope not. We're going to talk about investing. It's a big difference between investing and gambling. So let's start off this conversation as I did in the very first introductory slides with you. Why are you investing? Well, it's obvious you're investing to make money. Okay, well, there's a lot of ways to make money other than your day job. You could maybe write books. I don't know whether that works or not, but you can try. Mowing lawns, sure, you can make money doing that. Selling your art, flipping houses. I mean, there's just so many different ways to make money. For me, investing is a non-active way. These are all active things that you can be doing in addition to your day job. Investing, done right, doesn't require action on your part, just a one-time buy and hold. So it's a non-active way of making money. So I could use those monies I'm investing, I could use those to actually create a business. But then I'd be actively engaged in creating a business as well as my day job. I'd be working twice as hard. So investing for me is passive. This is the most important question I ask you. Why are you investing? And I seriously want you to think about that. Knowing why sets your guidance and helps you control your emotions. Controlling your emotions is really vital in our investing world. I think you should be investing for your retirement, your generation. Again, I think I'm talking to 20-year-olds, 20 somethings, and people into their early 30s. This is really critical that you invest for your retirement, particularly given the possibilities of Social Security not really providing much of anything in your future. So when you do that, you're taking, say, $50,000 and we're hoping it grows to 2 million. And I'm going to show you that in chapter 13. That's a 4,000% growth. So if we see a swing in the markets of, say, 3% in a day, which is a massive change in the market, that's pretty small compared to what we really need. So we don't get, when you're investing for multi-decadal timelines, buying and just holding and holding and holding for decades and decades, you don't really get too worried about what happened, in the markets in a day, a month, or even that given year. However, if instead you're investing for a down payment on a house, that's not a multi-decadal timeline. That's maybe several years. Maybe you're 25 years old and thinking you'll buy a house in your early 30s. So 5, 6, 7 year timeline. Well, then, yeah, then sudden market changes, such as 2, 3% on one day. That's kind of comparable to the growth you need. Let's say you have $50,000 and you need $150,000 for a down payment. Then, yeah, that's only a 200% growth, and 2, 3, 4% swing in a day could be really, kind of concerning. So, nevertheless, I think we should focus here on our retirement. Man, you don't want to be working literally until the day you die. That would be just awful. So we really want to think about our retirements. And again, a reminder of just what do you need to have in order, how much money do you need to have in order to retire? And this was a plot I've already shown you at the beginning of all the presentations. So we have age across the bottom axis here. This is the amount of money you have invested, $1 million, $2 million, or $3 million invested. This is the blue line. That's how much money you are extracting from each of these green lines, and you're living on this amount in your retirement at these ages. And remember, this is, say, 40 years in the future. This $121,000 number is the equivalent of about $55,000 today, the equivalent of the average starting salary for a college graduate today. So as we subtract the blue line from the green line, we see that $1 million runs out in less than 10 years. That's not good. You're going to live longer than this in your retirement. $2 million becomes our minimum goal. That gets us into the late 80s, your age of late 80s. And like I say, maybe this blue line, you're going to spend less and less as you get older. You don't travel as much, etc. And the green line might go crossing the zero then a little bit later into your early 90s. So 2 million is the minimum target for us. So you're going to need to have at least $2 million by the time you retire. And I know that's deeply sobering, but as you're going to learn in these 9 chapters, you can do it. You can definitely do it. I think Social Security will exist, but the payouts from it are going to be really much smaller than they are today. So we really want to focus on you investing for your retirement. So there's models and there's measurements showing us how to achieve this $2 million. And this is actually a very encouraging model for us. This is Formula 4 from the investing formula spreadsheet. We're going to say that we're going to have an investment growth rate of a 7.5%. As I'll show you, the S&P 500, I know that sounds like jargon right now, so let's call it the US markets for investing, have grown at 10.5% when reinvesting dividends over decades and decades. When we look at individual years or individual 3, 4, 5, 6 year timelines, well, yeah, it's not really 10.5%. But when we look at multi-decadal timelines, it's about 10.5%. So this is pretty conservative growth rate in comparison. It's less than 10.5. We're going to invest $7,000 per year for 40 years. And $7,000 is right now the maximum you're allowed to invest into your IRAs. And it goes up a little bit each year. It goes up, usually keeping up with the cost of living. So we do this math inside the formula, and after those 40 years, you'd have $2 million. And that's conservatively here. So it can be done. The model shows us this can be done. We want to be careful. We're hoping that the last few years aren't actually the lost decade when there is no growth. There was an entire decade from the year 2000 to 2011 where there was no growth in the markets. So we're going to talk about the lost decade, but we're going to hope that doesn't happen at the end of your 40-year investing timeline. So on average, this seems like a possibility. So that's a model. How about measurements? Remember, I'm always talking about models and measurements showing us what we can achieve. And so here we're looking at a timeline starting in 1989, so that's 35 years ago, going all the way to very recently here, 2024. And this is the amount of money that you have in your investments. Now we're going to have this green line. There's a green line and a blue line. The green line says, hey, in 1989, this person invested $50,000 in the S&P 500. They reinvested their dividends and held this in a tax-deferred account. Now, right now, a lot of that sounds like jargon, but don't worry. We're going to go over each and every one of those points in the upcoming chapters. What I want you to do is just see that this person, they had $50,000 35 years ago and did nothing after that. They didn't do anything with their investments. They didn't add anything to this green line. They just simply invested that and let it go. And look what they had. Now, that were some bad times. This is the lost decade right in there. But look where they ended up at, 1.73 million. Not too bad. We're going to see later on that the average actually would be $2 million, give or take half a million. We'll come to that. If instead they invested the $7,000 annually, like the model just showed us, and they increased that $7,000 by 2% a year, their total investment would be $355,000. And we see they start way down here in 1989 with $7,000, and then they keep investing 7,000, 7,140, and so on as we go future investments growing at 2% a year. Then they follow the blue line. And look, they end up at almost $2.5 million. So the models and the measurements show us it is possible to hit this $2 million goal. Now, this particular set of measurements is just sort of a one-time instance, starting in 1989, ending in 2024. What happens if you started a few years earlier and ended a few years earlier? So we're going to look into those details. This is a table at the end of chapter 7, and I really invite you to spend some time thinking about this table. We're going to compare and contrast what's investing versus what's speculating. Actually, it's gambling. What's investing? Remaining focused on why you're investing. And I really encourage you to focus on your retirement. Gambling? That's just trying to get rich quick. Hey, I just need some money like right now. Understanding risks. That's what investing is. We're going to look at a couple of statistical definitions of risk. Gambling is just having an indifferent attitude about risk. Hey, everything's risky. Investing is having a balance between lower and higher risk assets, bonds and equities. We're going to talk all about this in our asset allocations. What's gambling in comparison? Just chasing after hearsay. Hey, a friend of mine told me about his friend who made some money in Bitcoin. Man, I have heard that story over and over. I'd like to meet this friend of a friend. I never get to meet the friend of a friend. This is just getting lucky. You don't want to bet on lucky. Invest for long term, decades and decades. What's the contrast of that? Have a fear of missing out on some exciting stock that you're hearing about being promoted on the internet. There is always the next exciting stock being promoted on the internet. And you get a fear that you're not part of the party. That's why we're going to focus on decades and decades of investing, and we're not going to have FOMO. This is so critical. This is so critical. That's why I keep talking about reading books. You're going to build your confidence by reading really quality books. I prefer the books by academics because those have been peer reviewed. We academics go through some pretty heavy scrutiny when we start publishing. The book by Burton Malkiel is just an excellent book, and I highly recommend that. After you read that, and maybe reread that, you'll really build your confidence and trust yourself in understanding investing. The opposite of that is just not trusting yourself and saying, well, I'm sure somebody knows how to do this and I'll just go ahead and pay them. You're going to see how expensive financial planners are. Or maybe you might think that Googling or reading some web pages, this is speculating, this is gambling. We're going to avoid the right side of the table and do everything over here on this left side. So, my investing recommendations to wrap this up: read books, control what you can control. You can control your emotions, don't have FOMO. And we're going to try to avoid these investment related fees. We're going to keep them bare minimum. We're going to avoid short term gains taxes. We already learned how expensive those are. We're going to, by investing in our IRAs and 401ks or using long term investing strategies. And we're going to control the equity bond asset allocation. So I'm going to talk about this equity bond asset allocation coming up in future chapters. We're going to buy and hold for at least 3 decades, preferably longer, preferably 35 years. Purchase a passively managed fund that follows the broad market index, such as the S&P 500, reinvest the dividends. Similarly, purchase a smaller amount of a passively managed bond fund and reinvest the interest payments. This sounds like a lot of jargon. We're going to go through all the details of this so it becomes very familiar with you. Definitely don't day trade. Boy, I've met a bunch of day traders. They rarely make any money. They talk all about it, but they don't actually make money. You can do this. You can do these investing strategies. You can open your own investing account with an online brokerage like Vanguard or Schwab. There's others you can choose as well. Paying an investment advisor, that can cost you literally hundreds of thousands of dollars. I'm going to show that to you. And invest the maximum amounts allowed in both your IRAs and 401k. All right, thank you. Let's get started.